Right. Good afternoon, everyone. We're going to get started. Thank you all for being here. My name is Brittany Cartwright, and I'm the Director of Membership Development here at the Palm Beach North Chamber of Commerce. Being here with Thomas Quayle with Nottingham Advisors, our speaker of the day. Before I talk to you about a brief description about Tom, I want to go over some housekeeping items. First and foremost, you all are in listen-only mode, so please do not unmute yourself. Just because there might be some disturbances in your background, we will have time for questions at the end. We do ask that you put your questions in the chat box, and in order to get there, you can actually hover over your screen. There's a chat icon on the bottom middle hand of your screen that you'll click, type in your question either to Bianca Colon or to everyone, your choice. Bianca will go over questions towards the end. Now on to our speaker of the day. Tom is the Chief Executive Officer at Nottingham Advisors, an SEC registered investment advisor based in Buffalo, New York, with an additional office in Palm Beach Gardens. Tom graduated from the University of Buffalo in 1989 with a degree in economics and began his investment career immediately upon completion of his studies. He currently sits on the investment committee of Nottingham Advisors, helping to manage the over $1.2 billion client assets entrusted to the firm. In addition, Tom is responsible for directing the firm's overall business development and growth strategies. Tom is currently a trustee on the board of University at Buffalo Foundation, holds leadership positions in several chapters of the Young Presidents Organization, such as YPO Empire State and YPO Palm Beach, and is a director on the board of the Buffalo Renaissance Foundation. Without further ado, take it away, Tom.
Great, thank you, Brittany. Welcome, everyone. Thank you for taking the time to join me today. As Brittany said, I'm Tom Quayle, the CEO of Nottingham Advisors. Excited to be here today. We're been members of the chamber now for, I guess, about a year, so relatively newer members. Firm has an office up here in Buffalo where I'm sitting now, and down in Palm Beach Gardens where I wish I was sitting. So again, thanks everyone for being here. So what I was looking to do today is just sort of discuss from a introductory level, discuss environmental, social, and governance investing, or ESG is one of the other names that it's commonly known by. I'll try to define what it is, bit of the history of it, as well as some of the driving forces behind what we think is a significantly growing trend. Excuse me, can you hear me?
I'll send Julie a chat right now to try to help her in getting her sound working. You can go ahead, Tom.
Okay, thanks. So we'll talk a little bit about, as I said, the history of this type of investing, what we think are significant driving forces behind this growing trend, and then talk a little bit about how one could think about building a portfolio that features this kind of view to it, and then we'll leave some time for questions at the end. So again, thanks everyone for joining me, and we'll get started with what is ESG investing, kind of define it right to get started. So it is incorporating environmental, social, and governance research and factors into the investment process. It's an investment philosophy with the intention to perform on a risk-adjusted basis equal to or better than traditional investment strategies. So really what that means is we're going to be able to do good by doing good. So we can make money and we can feel good about our contribution to doing so. And it's also engagement with companies that fall short in certain areas or key performance indicators. It always used to be that if there was a company that was doing something or performing in a way that we didn't like or didn't believe in, we would simply just sort of ignore that business or not invest in it. But ESG investing and thinking about things this way actually can cause us to engage with companies, and hopefully, rather than avoiding them, we can show, hopefully maybe spark some positive change. And getting a company to rethink the way they do things or how they approach their product or services and do things in a more socially responsible way. And there's a lot of different ways to think about this, and we're just going to talk about some of them, but it really becomes a personal view, and how one thinks about this is how this journey can go. So starting with some major ESG factors, just to give you a sense of what we're talking about. And there are many more than what is listed here, but we kind of say the E, the S, and the G: environmental, social, and governance. So just a couple of things we have listed there under the environmental label, or the E. Think about climate change, think about waste and pollution in the environment. From a social perspective, we can think about working conditions. We can think about employee relations, the diversity of our employment and our employment base. And we can think about governance, executive pay, board diversity and structure. So just a lot of different things that can be thought about. But we do feel, and evidence is growing to show, that increasingly companies will be evaluated in their attitudes towards these principles that are listed here. So it's definitely worth keeping an eye on these types of things. So the thing oftentimes is people don't necessarily have a sense of where this sort of thought process came from, and maybe there's a sense that it's a newer sort of approach to looking at the world. But we put together a timeline to show that that's really not the case. It's not a new concept. It's been with us for a while, and again, just simply gaining momentum. So just a couple of things I'll highlight here. Back in 1985, the Forum for Sustainable and Responsible Investing was started. 1992, the United Nations held a conference on the environment and development. So a global summit. So on a global scale, businesses and companies and countries were thinking this way. And then one of the real major drivers began in 2015, and we're going to talk a little bit more about this on the next slide. But the United Nations, they adopted their 17 Sustainable Development Goals. And again, we're going to look at those and what they are in a minute here. 2019 was a significant year for money that flowed into these kinds of investments. There was $20 billion that flowed into ESG-oriented funds, and that's almost a fourfold increase from just the year before. So again, there's just a huge groundswell that we're starting to see. And one other thing that was really interesting, and we're going to touch on this more later, is how would these funds, there was a question about how these types of investments perform. And in 2020, in the first quarter, it was a really big test for ESG funds to see how they would do in a bear market or a significantly volatile market. And they fared very, very well. So they really passed their first big test. So that was exciting to see. And I think will just be something that's going to be as a tailwind for this kind of strategies. So as I said, the United Nations Sustainable Development Goals, and this kind of coalesced everyone's thinking around a group of concepts. So again, first articulated back in 2015, but it's a group of concepts that individuals, companies, and organizations can collectively focus on when trying to do their part in tackling global challenges. So it's everybody focused on a group of thoughts. You'll see if you look at these: no poverty, zero hunger. I mean, they're clearly wonderful objectives, but they're also extremely aggressive ones. So I think our vision here and the way we measure this going forward is not do we achieve these goals anytime soon, but it's what kind of progress are we making towards these goals. That's going to be what's really important. Are we trending towards the objectives that are stated here? And part of it too is all of these are important. There's no question about that. But some of these will matter more to others. Some individuals will feel strongly about some of these and not about others. Some geographic areas, like as I sit up here in Western New York, there just isn't the sense of the concern with the water. We're not surrounded by the ocean and all the life that exists in the ocean. So, numbers 13 and 14, certainly 14, aren't as prevalent up here as they would be down in South Florida, where certainly the oceans and the life that's in the oceans is a much more important objective and certainly more part of everyone's daily life. So 17 ideas, things that we all can kind of think about and hopefully make some progress to as we move forward. So I kind of like just to throw in a couple of things to break things up a bit. So this is our first fun fact. It's a company called 4Ocean, and their purpose is you may have seen commercials for them on TV, but their purpose is to end the ocean plastic crisis. Now, obviously, that's a huge objective, but they're looking to clean the ocean and coastlines while working to stop the inflow of plastic by changing consumption habits. So there's a lot there, but it's a cool company, and they sell merchandise. So for $20, you can buy a bracelet, and they say that every $20, every bracelet that you buy will remove a pound of plastic from the oceans. And I just, in fact, got an email from them this morning. So they said collectively they've pulled almost 9 million pounds of trash from the oceans and 100,000 pounds just this month of May. So pretty aggressive undertaking. They're having a lot of success. On a smaller scale and a more local scale, there's a non-for-profit in Palm Beach called Friends of Palm Beach that some of you may be familiar with. They do the same thing. They work to clean up the beaches of Palm Beach County, and they do a tremendous job locally. So it's something that's kind of interesting, and we're just seeing an increasing focus on this particular environmental challenge. So, all right, so moving on, like, why invest responsibly? And there's a handful of reasons here. Ultimately, this does become a personal thing, and so everybody might list their own reasons for why they do so. But again, aligns investments with personal values. So you can contribute towards making a difference in shaping corporate behavior, meaning if you're investing in companies that are doing the right things, then that just further supports the efforts of those companies. And that's how we ultimately can have a positive impact on the society or the environment. Historically, and this is one of the main reasons as a firm, we obviously believe in environmental, social, and governance issues, but we can build portfolios that actually have improved historical or improved portfolio characteristics, meaning when you look at historically how companies that are ranked high from an ESG score, they have indicated their stock prices are less volatile. Those companies generally have lower earnings risk. They have higher profit margins, and the profits are less exposed to competitors or competition, and they're less likely to experience financial distress. So as a group, companies that are ranked high from an ESG metric also exhibit a lot of the characteristics that an investor would want to see in an investment portfolio. And again, as money flows towards these companies, we can hold them accountable, and therefore we can have an impact. So there's a growing opportunity to do that because this type of thought is becoming more acceptable, and it's almost expected to have that the companies are going to have an opinion on this and be able to articulate it to investors. So, and currently there's over 500 mutual funds and ETFs that are available now that take a variety of approaches to socially responsible investing. So there's plenty of opportunities to invest your money in this fashion. So continuing with the why invest responsibly part, this slide gives you a sense sort of the current situation that we find ourselves in around the world, and not to be doom and gloom, but we do have a ways to go on some of these issues. You can see, and a lot of these bullet points here are things that are impacted heavily by emerging market economies and countries. So we're not going to see all of these things necessarily here in the U.S. directly, but still we're influenced by them. So 1 in 5 people in developed regions live on less than $1.25 a day. Many children, millions of kids around the world are not currently being educated. Greenhouse gas emissions continue to rise. Water scarcity is a major issue around the world. Women in labor markets still haven't gotten their compensation up to where men's are around the world. And I touched a little bit about the ocean. So we can all play a role in this, no matter how small. We can all contribute towards improvement here in our own way, in the things that we do every single day. So we can do our part to make a difference. And what's becoming more aware to people is you can make a difference without sacrificing returns. I think, as I touched on earlier, it used to be that if you wanted to invest in a socially responsible way, 10 or 15 years ago, for example, you were basically just avoiding certain companies, tobacco or alcohol or firearms, whatever your particular concern was, you would just not invest in those companies. So those ways of investing where you're just sort of excluding things, they tended to be expensive, and they also tended to underperform. So, having higher cost structure and underperformance is not typically a good way to go about things. So we believe that you can get better outcomes with ESG integrated portfolios, and there's recent studies, according to recent study by Morningstar, that ESG-based investment portfolios may lead to improved investor outcomes. And that's really important, because it means that these portfolios, Morningstar did a study, they went back 3 or 4 years, and they looked at ESG-oriented investment options versus more mainstream ones. So mainstream being like the Dow or the S&P or large cap companies without any ESG screenings at all. And increasingly, it shows that ESG research should be incorporated into the investment process, because 73% of the ESG industries studied outperformed their traditional benchmarks, or their traditional comparisons, and 84% experienced reduced volatility. So if we can build a portfolio that we feel good about, that we feel like we're making a difference with and aligns with our views, and that portfolio can perform well and be less volatile, that's really a significant combination of things that I think most people would strive to achieve. And we do still think, even though there's some history here, we feel we are in the early stages of what we think is going to be a long-term trend. And demographics will play a large role in that. So $68 trillion generational wealth transfer from baby boomers to their Gen X and millennial children over the next several decades, significant amount of money. And so, and you'll see in a second, actually the next slide, we talk about sort of what demographics are more interested in this versus others. But regardless of that, we're seeing that a growing percentage of high net worth investors are reviewing their portfolios, and they're taking into consideration ESG factors when they're putting together their estate plans, because they know that it might not be something that's on the tip of their tongues, but their heirs, it is. Their children, the people that they're going to be transferring their wealth to, it is increasingly something that they're interested in, and they want to make sure that their estate reflects what their heirs are interested in and would like to see. So it's a rapidly evolving environmental, demographic, and technical trends require sustainable solutions from companies. Companies are going to be expected to address all of these concerns we all have about their attitudes towards the environment and towards social issues and towards governance issues and how the businesses are run. Increasingly, they have to have a position, and they'll be penalized if they don't. Many countries around the world have implemented or are beginning to develop actual rules and laws. We're not there yet in this country. I don't know that we will be, but I think even if our government doesn't take a position on this, the investment community will. And as there's various evolving rating agencies and a number of different entities that will take an active role in this, and just to make sure that it continues to be monitored and modified going forward, so that people have good information when they're looking to make these kinds of decisions. So who's leading the way in impact investing? So here's just a couple of statistics. Generally speaking, the majority of millennials, Gen X, and women agree that a company's track record on ESG issues is important consideration for investing. So you can see the stats at the bottom. 64% of women versus 46% of men say this is important to them. 87% of millennials, 65% of Gen Xers, and then on to the boomers and the silent generation, less interested. So generally women more than men, younger people more than older people. But you think about that, those are powerful demographic trends that, you know, the millennials being the youngest group, and eventually will have accumulated assets either through their own efforts and certainly through money passed on from one generation to the next. There's going to be an increased amount of money that they're controlling and influencing. So we do think that they're going to continue to have a meaningful impact on this. And here's just some evidence. Sustainable funds estimated annual flows over the last about 10 years. So we see significant evidence of the growing power of this trend towards investing in a socially conscious way. You can see last year, huge increase, 2019 over 2018, more than quadruple the amount from the year before last year. So it's just a significant trend of assets flowing in that direction. And that money will flow into mutual funds, it'll flow into exchange-traded funds, it'll flow into individual securities or equities of companies that are highly rated on ESG. So flowing all into those directions. But again, that's a lot of money. And when you have that kind of money, that kind of significant increase year over year, it tends to get people's attention. So maybe people that hadn't really looked at this before will start to look at it now. All right, another fun fact. This is a quick one. Adidas. So it was interesting to know that Adidas is also part of a growing number of companies that are supporting ESG principles. So they're also reusing ocean plastics, but they're reusing it for football fields and soccer fields and all kinds of artificial playing surfaces. So what we just kind of found interesting is that companies that you might not necessarily equate with an ESG or environmental or social governance attitude or approach are involved. So Adidas is just another example. I'm not going to talk a lot about Nottingham Advisors necessarily or how we specifically do things, because that's kind of not the purpose of our time together today, but I am going to touch on a few things because I think they're sort of educational. It just kind of gives people an idea of maybe some of the resources that are out there, how you might think about building a portfolio. So I'll just touch on the objective. So what we're trying to do is to build a strategy that seeks long-term growth of capital with some current income by aligning investments with highly ranked securities using ESG criteria from leading data providers. So very simplistically, that's what we're looking to accomplish. And so how do we do that? So this is just sort of a graphical picture of our investment process. And again, not because to give you the Nottingham story, but there's a couple things I just want to share that I think are informative. And so we use industry leaders Sustainalytics and Morningstar are two of the sources that we use to screen not only equity but also fixed income, we'll get to that in a minute, mutual funds and ETFs on their ESG characteristics. So this inverted pyramid just kind of at every step just kind of chunks it down a little bit. So you start with the full universe of exchange traded funds and mutual funds, over 20,000. Then when you shrink it down to just ones that are ESG oriented, which is, again, that's the area that we're focusing on, we're down we're over 500 from there. And then what we factor in at the next step to shrink it down even more is Morningstar sustainability rating. So Sustainalytics is a company that's a global leader in ESG and corporate governance research and ratings. So what they do is they look at it's almost 8,500 publicly traded companies around the world. They look at them for all of these ESG characteristics, what they're doing today, what they're trending towards, and what's the trajectory of the company around all of these issues. And then they assign a rating from 0 to 100. And then Morningstar takes those ratings and they look at all the holdings within each of the funds that they're analyzing, and then they provide a score. So they give, instead of like the traditional Morningstar rating system uses stars, this system uses globes. So ultimately then they will give a rating to each fund, 1 to 5 globes, based on their attitudes and progress from an ESG perspective. And then we use various liquidity screens. We look at the managers. We see the process, how the funds are run, performance, and other issues. And ultimately to get down when we're actually building the portfolio. But Sustainalytics and Morningstar are two names that you may see if you're looking into ESG research. And again, that's a big part of the research process that we use. But it's not just for equities. Fixed income can be viewed from this lens as well, and it should be. So ESG analysis is done for the bond section as well. There's different types of bonds that are out there that one can consider. Corporate bonds, Sustainalytics, as I mentioned before, they're giving ESG scores to companies. So we're going to look at Sustainalytics' overall rating on that company to get an assessment of that company's corporate bonds that they issue. So government bonds, it's a different metric. So Bloomberg has an ESG country risk score. So if we're considering government bonds, mostly of the US, but certainly if we're looking at other countries around the world for investing in fixed income for that portion of our client portfolios, then we would look at the Bloomberg and their ESG country risk score to determine, the suitability of an investment from that perspective for a client's portfolio. And then sort of a newer side of the fixed income world are green bonds. And that's where you're analyzing the environmental or social goal of the bond to align with a client's portfolio values or the views that we're looking to attain. And that's where companies, like use Apple, it's a great example. They'll issue a bond for the purpose of making all of their, or a particular factory, energy efficient. So anything that supports that type of endeavor could be considered a green bond. But again, we're using the fixed income allocation, mutual funds, ETFs, individual bonds, and they all have ESG ratings that we can look at as we're building that fixed income portion of the portfolio. Last fun fact, this one isn't as fun as the first two really, but Apple's just always an interesting example. Leading company, obviously, and especially in the environmental part of the equation, but just the significant progress they made we think is interesting. So climate change, their goal is significantly reducing emissions to address climate change. So they've gotten to the point where 100% of their global factories are powered by 100% renewable electricity. Pretty amazing. And they also are transitioning to using renewable or recycled materials for the manufacturing of their products and some of the packaging. So they've got to the point now where 100% of recycled aluminum enclosures in their MacBook Air and Mac Mini. So, as I said earlier, this is a road, this is a process, and every company is going to be various progress down that road. Apple might be a little bit further along in certain things than other companies, but it's just interesting to see the significant progress that a big company like Apple has made on that front. So I'm not going to talk too much about this specifically, but this just kind of is our example of when we talked about the globes before. Our portfolio has a 4.2 out of 5 rating. So it's relatively high. We think it's going to get higher as we move forward, but when I share this page with people, a lot of times people will ask, so if I'm investing this way, what kinds of companies do I ultimately own, or what can I ultimately own? Give me some examples of companies that are going to score highly on ESG metrics. So some widely held names: Microsoft, Apple, Waste Management, MasterCard, Ecolab are companies that are very highly rated, and you'll see throughout anything that's got a high ESG rating. But some of the other names, like one in particular, Best Buy. Recently, Barron's ranked their top 100 companies by sustainability from an ESG perspective, and Best Buy was the #1 ranked company in the U.S. from that perspective. Kind of interesting. Cisco also is highly ranked. Like Agilent Technologies, they were highly ranked because of board diversity. They actually give paid time off for their employees to do volunteer work. Hewlett Packard, another highly ranked company, they have their compensation of their senior management team is actually tied to a list of ESG objectives. And Voya Financial, another company that they're committed to diversity and gender parity. So they believe that their decision making is better and their profitability is higher when they factor in diversity and gender issues. So really interesting, very successful companies that are all making significant progress on these metrics, and so well-established companies that any ESG strategy would probably have some exposure to. But like I said, when I talked about our ESG score for just a particular sample portfolio, we expect that 4.2 to rise closer to I don't know if we'll ever get to 5, but we expect it to get higher, because the ESG landscape is continuing to evolve, and will likely, and we expect it will continue to evolve for many years to come. And companies will continue to make identifiable progress, measurable progress, and we're going to expect to see more and more companies ranking highly from an ESG perspective. So it's going to give us more opportunities to invest in more companies to consider. This page I thought was just sort of a good summary, because these are questions that we get a lot as we're having conversations with people about ESG. So we thought maybe just address some of the myths that people have around this idea, and I think we can probably debunk most of or all of them for sure. So first one, ESG investing is philanthropy. We are sacrificing performance, and that's not true at all. We addressed that on slide 9, and we think that there's every opportunity to make money investing this way, and it's not just doing good; it's actually making money as well. ESG investing is just avoiding sin stocks. It used to be that all we would do is avoid things, and that's how we would approach this topic, but it's not anymore. It's really much more about engagement. And it's all about green investment. That might be the most obvious that people think of, but it's really about much more than that. And on page 5, chart 5, we talked about what some of those other issues are, because there's the social and the governance part of it as well. A lot of times people think ESG strategies involve higher risk, and we also addressed that on a previous slide. They don't, and each quarter that evolves just continues to give more support to that. And as I mentioned, we saw that in the first quarter, where generally these strategies were more volatile than the overall market was. It only works for stocks. Again, we just talked about that on chart 16. You really can and should apply this line of thinking and look at this through this lens for your entire portfolio, including the fixed income side. There are no standards for company reporting around ESG. It's one of the questions we get often is who's handling these ratings and scorings, and is there any sort of broad uniformity or uniform approach that's brought to it? And there's several widely accepted rating agencies or rating sources. I mentioned Sustainalytics, I mentioned Morningstar, there's Bloomberg, there's MSCI, to name a couple. I'm involved with the University of Buffalo Foundation, and we use a consultant called Mercer. That's a global consulting firm. And every investment recommendation they make to us as a committee, they have their own proprietary ESG rating score on. So they don't come to us with any idea that doesn't have their own proprietary ESG rating. So we're going to see more of that. And we're going to see just more of those types of proprietary rating processes coming out. So from that perspective, it is a little bit of, it's a little bit less uniform than maybe some people would like, but there's certainly plenty of sources out there. Then the key is just understanding the methodology that any particular rating agency uses, I think, as we look at this idea of scoring and trying to get ratings. The other one is we get, surprisingly, is ESG strategies might compromise my fiduciary responsibility. And it actually couldn't be farther from the truth, because to solidify your fiduciary responsibility, we have duty of care, and we want to make sure, and other things, that we just want to make sure the portfolio is invested properly. And we've demonstrated, and the numbers get better and better, that these strategies tend to perform well with lower overall risk profile. So those are things that certainly would support an ESG, or any fiduciary responsibility that one might have. So just to kind of summarize, there's a lot about investing this way that is still unclear to a lot of people. I think the next few years we'll see a lot of education, and as we see that money flowing into these types of strategies, it's going to get people's attention. People will educate themselves around it, and I think when they see the value of it, we're going to see increased adoption, and we'll see more money flowing. And then we're going to see, we believe, investing in an ESG perspective will move closer to the investing mainstream than it is today. And we envision potentially where ESG is just going to be so expected by investors that it almost in and of itself won't even be really a thing anymore, because everyone's these companies are going to have clearly messaged their thoughts and attitudes and the things that they're doing to support this line of thinking. So investors won't even have to ask. So we're excited about the future of it. We think there's plenty of money there. There's going to be plenty of opportunities to make money. And the portfolios will continue to get more creative and more sophisticated as we move forward, because we'll have more investing options. So that's it. I wanted, again, an overview. And as you could probably guess, our firm specializes in working with investors. We build customized, separately managed portfolios. And there's just some of the metrics relating to our firm. We've been around since 1981, manage about $1.2 billion, and again, offices up here in Buffalo, and my preferred one down in Palm Beach Gardens. So, so with that, I can take some questions. I can take some now, or if anyone wants to discuss anything offline at a later time, we can do that as well.
All right.
Like I said, back to.
We have 4 questions. So question number 1, since women and millennials are most interested in an ESG portfolio, are they the ones who manage their family's investment process?
That's a good question. What we're finding is it depends on the family, but we're finding in a lot of cases that the older generation is including the younger generation as they make those family plans. They're including them in it, not to necessarily manage it per se, although in some cases they may. But I think the older generations want their heirs to know how they're invested, where things are, how they're organized, who's involved. And that way, when that day comes, it makes the transition a lot smoother. And sometimes we have some clients that have passed off the actual management and oversight to their heirs while they're still here, and they haven't, so there's a lot of different ways to look at it. But I've seen where it's been very successful is where the kind of the patriarch or the matriarch of the family includes the next generation, at least in maybe some planning and understanding how things are. And then it's up to the individual family in terms of who has what responsibility. But the process does flow smoother when everyone's understanding it and understanding what's involved and the different metrics and different components of it.
Great, thank you. Question number 2, how much of a difference or influence do companies like Adidas have on other companies who support of sustainable initiatives?
No, that's a good question too. I think it makes a big difference. Because if you think about it, especially with publicly traded companies or private ones for that matter too, they're competing for capital. Us as investors have money to allocate, whether it's a lot or whether it's a little, and we have choices. So as more and more of us look at life through this ESG lens, we're going to have options. Do we invest in Adidas or Nike? And you can consider the two. And if one you feel has an exemplary record towards these factors, and you feel that's more in line with your views, then your capital is going to flow towards that company that you feel is more in line with your views. So if a company is seeing money flowing to their competitors for these reasons, they're just going to be forced to sort of keep up, I think, and sort of make sure that they're looking at life. And a lot of it's communications. A lot of it is communicating with the investment community and just what companies are doing specifically around these topics. And we're seeing them getting better and better at that. But I do think they do influence each other because they're essentially competing for the same dollars.
Perfect. Question number 3, how replicable is what Apple has done for municipalities?
It's a good question because Apple has all the money in the world, I think, and municipalities don't. So I think it's replicable for sure. It's going to be very unique for each individual municipality, depending on geographic locations and otherwise. But certainly with Apple's movement towards renewable energy, those are things that we can all strive towards and we can all make progress towards. But it does unfortunately come down to dollars and cents. I mean, there's a short-term investment that needs to be made for that long-term gain. And I know the University of Buffalo, their objective is to be totally carbon neutral and generate their own every ounce of energy that's used on the campus. They want to be generated there with renewable sources by 2025. My suspicion, though, is given with what's happened lately with the pandemic and the effect it's going to have on it's dollars and cents, that might push off the investments that they're going to make in those green energy options. But I don't think they may at worst be pushed off. But I think they're replicable for sure.
Perfect. And final question I have from the guests is ESG investing the same as SRI investing?
Socially responsible, yeah, it is. It's a good point because there's a lot of different names that this goes by, and sometimes the lines blur a little bit. But socially responsible, could maybe become a little bit more of a finite approach on just sort of the social part of it. There's impact investing where people will just, if they believe in renewable energy, then an impact investor would just invest their money in that. They wouldn't necessarily be as focused on governance or other factors. They would just focus on one particular thing that they choose to impact with their money. So that's where it kind of gets back to all the individual views. There's a lot of different ways to look at it. From our perspective with ESG, it is looking at all three factors, but you can zero in on just the environment, you can zero in on just social, you can zero in on just governance, or you can even zero in even more than investing like a particular industry or sector or just some particular endeavor that you want to support. So there's a lot of things that are similar to them, but they do have sort of their own, sort of intricacies.
Well, perfect. Thank you so much, Tom, for spending your afternoon with us. Thank you on behalf of the Palm Beach North Chamber of Commerce and our guest attendees today. Attendees, if you have any questions for Tom and you do not have his contact information, please send me an email and I can put you two in touch. Otherwise, his information is at the bottom of the PowerPoint screen. And I hope to see all of our guest attendees tomorrow at 4 p.m. We have a tech toast, so find more information on our website for that. Thank you all. Have a good one.
Great. Thanks, everyone.
Thank you,
Appreciate
Tom.
the time. Bye-bye. Bye-bye.
Bye.